Ever wondered why we don't just have one financial statement that shows everything? It seems like it would be much simpler, right? Well, the truth is, most businesses are complex and their financial activities are multifaceted. Perhaps a very small private firm can make do with just one statement. But as companies grow and interact with the broad financial world, the need for a more comprehensive picture emerges. That's where financial statements come in. Think of them as different lenses, each providing a unique perspective on a company's financial health. Hi there. If you're new here, my name is Joe, and I make videos that help to simplify complex topics like accounting, economics, statistics, finance, and other related fields and make them accessible to everyone. My goal is to supplement your learning process, whether you're a student, a professional, or just someone who wants to be more financially literate. So if you're ready to ditch the flashcards and truly grasp the concepts behind these topics, you're in the right place. Stick around and let's learn together. Let's get started. Think of a company's financial health as a complex puzzle. Each financial statement is a crucial piece, providing a unique perspective that, when combined, reveals the full picture. In this video, we'll be focusing on the four primary pieces. First, the balance sheet is a snapshot in time, showcasing what a company owns, or also known as assets, and what it owes, or also known as liabilities, and the difference between the two, which is your equity. Next is the income statement, which is a dynamic report revealing how much a company earned, or it's known as revenues, and what it spent, also known as expenses, over a specific period, culminating in its net income or loss. Then comes the cash flow statement, which is the lifeblood of any business, tracking the inflows and outflows of cash from operating, investing, and financing activities. Finally, the statement of retained earnings, which is also known as the statement of changes in equity, is an insightful look at how a company's ownership stake evolved over time, detailing contributions, withdrawals, and net income impact. Each statement tells a unique part of the financial story. By understanding how they interrelate, we can gain a holistic picture of a company's financial performance and position. So let's dive deeper into each one, starting with the balance sheet. The balance sheet is our first stop on this financial journey. It provides a snapshot of a company's financial position at a specific point in time, usually the end of a quarter or a fiscal year. Think of it as a photograph capturing the company's financial state in that moment. At its core, the balance sheet revolves around the fundamental accounting equation, which is assets is equal to liabilities plus stockholders' equity. Let's break down each component now. First, assets are the resources a company owns or controls that have future economic value. This can include tangible items like cash, inventory, and property, as well as intangible assets like patents and trademarks. Then liabilities, these are the company's obligations or debts, representing what it owes to others. Examples include loans, accounts payable, and accrued expenses. And finally, equity. This represents the residual interest in the assets of the company after deducting liabilities. It's essentially the owner's claim on the company's assets. The balance sheet is organized in a specific way, typically listing assets in the order of liquidity, that is, how quickly they can be converted to cash, and liabilities in the order of maturity, depending on when they are due. By examining a company's balance sheet, we can gain valuable insights into its financial strength and stability. We can see how much it owns, how much it owes, and how much is left for the owners. This information is crucial for investors, creditors, and other stakeholders in making informed decisions about the company. Next, let's explore the income statement, which will show us how the company performed over a specific period. While the balance sheet offers a snapshot of a company's financial position at a specific point in time, the income statement tells the story of its financial performance over a particular period, such as a quarter or an entire year. It reveals how much the company earned, which is their revenues, and how much it spent, which is their expenses during that time frame. The basic structure of an income statement is quite straightforward. First, you have your revenues, which represent the total inflow of economic benefits generated from the company's primary operations, typically through the sale of goods or services, right? Okay. Then we have all their expenses. These are costs incurred in the process of generating those revenues, including salaries, rent, utilities, and the cost of goods sold. Finally, you end up with the net income or loss. This is the bottom line, which is the final result after deducting all the expenses from revenues. A positive net income indicates a profit, while a negative one shows that there has been a loss. Okay? The income statement is crucial for assessing a company's profitability and efficiency. By analyzing its revenues and expenses, we can gauge its ability to generate income and manage costs. This information is essential for investors, creditors, and also for the management to evaluate the company's past performance and make projections about its future prospects. Up next, we'll delve into the cash flow statement, which sheds light on the actual cash movements within the company. Okay, now let's shift our focus to the cash flow statement. While the income statement provides valuable insights into a company's profitability, it doesn't always tell the full story about its cash position. This is where the cash flow statement comes in. You might be wondering, why do we need a separate statement for cash flow when we already have the income statement? Well, the key difference lies in the timing of revenue and expense recognition. The income statement is prepared using accrual accounting, which recognizes revenues when they are earned and expenses when they are incurred, regardless of when cash is actually received or paid. In contrast, the cash flow statement focuses solely on the actual inflows and outflows of cash during a specific period. It shows us where the cash came from and where it went. This distinction is crucial because a company can be profitable on paper according to the income statement, but still face cash problems if it has a lot of outstanding receivables or is investing heavily in long-term assets. It's worth noting that for small companies, which operate mostly on a cash basis, where revenues and expenses are recognized when cash is received or paid, the income statement and cash flow statement might look a lot similar. In such cases, a separate cash flow statement might not be strictly necessary. However, for most companies, especially larger ones or those with complex operations, the cash flow statement provides critical insights that the income statement alone cannot. The cash flow statement is typically divided into three main sections, which is cash flows from operating activities. This section reflects the cash flows generated from the company's core business operations, such as sales, payments to suppliers, and employee salaries, for example. Next is cash flow from investing activities. This section captures cash flows related to the acquisition or disposal of long-term assets such as property, plant, and equipment, as well as investments in other companies. Finally, cash flow from financing activities. This section tracks down cash flows from transactions with owners and creditors, such as issuing stock, paying dividends, and borrowing or repaying loans. By analyzing the cash flow statement, we can gain a deeper understanding of a company's liquidity and its ability to generate cash in order to meet its obligations. Next, let's explore the final piece of the puzzle, the statement of changes in equity. This statement is also sometimes referred to as the statement of retained earnings. While the balance sheet provides a snapshot of equity at a specific point in time, this statement shows us how equity has changed over a particular period. In essence, it tracks the flow of equity, highlighting the various factors that contribute to its increase or decrease. These factors can include first the net income, the profit or loss generated during the period, which is added to or subtracted from retained earnings, depending on whether it's a profit or loss. Then comes dividends, distribution of profits to shareholders. This reduces your retained earnings. Then issuance of new stock can also increase your value of stock, right? Okay, so the sale of new shares to investors can also increase equity. Okay, also repurchase of stock, which is the buyback of shares from investors, can also affect equity. In this case, it would decrease it. Okay, other comprehensive income, like certain gains and losses that are not included in the net income but can still affect equity. Okay, these include unrealized gains or losses on investments. Okay, the statement of changes in equity is particularly important for understanding how a company's ownership structure is evolving. It reveals how much of the company's profits are being retained to fuel future growth and how much of it is being returned to shareholders. It also shows how a company is raising capital and managing its share count. By examining the statement, investors can gain insights into the company's dividend policy, its capital raising activities, and overall, its approach to shareholder value creation. Now let's illustrate the relationship between the balance sheet and an income statement with a simple example by using an individual's finances. Imagine you had $10,000 in your bank account as of December 31. This is reflected in your balance sheet as of that date under the cash asset. In January, let's say you earned a salary of $5,000 and incurred expenses of $3,000. This information is captured in your income statement for the month of January. So your net income for the month is $2,000, which is $5,000 minus $3,000. Now, how does this net income affect your balance sheet? It increases your cash balance. So as of January 31, your new balance sheet would show $12,000 in cash. This simple example demonstrates a key connection. The income statement's net income flows into the balance sheet, impacting the equity section, specifically retained earnings. In other words, the income statement explains the change in your financial position during a period, while the balance sheet shows the result of that change at a specific point in time. Now, let's bring all four financial statements together and see how they create a comprehensive picture of a company's financial story. As we've seen, each statement plays a vital role, but they're also interconnected in meaningful ways. Income statement to the statement of retained earnings, the net income or loss from the income statement directly impacts the retained earnings in the statement of changes in equity. Okay, from the statement of retained earnings to balance sheet, the updated retained earnings balance then flows into the equity section of the balance sheet, affecting the overall financial position of the company. Now let's see how the statement of cash flows is related to the balance sheet. The ending cash balance reported in the cash flow statement must agree with the cash amount shown under assets in the balance sheet. This ensures consistency and accuracy in the financial reporting. Beyond these primary connections, there are numerous other links between the statements. For instance, depreciation expense recorded on the income statement reduces the value of plant, property, and equipment on the balance sheet. Similarly, changes in accounts receivable and accounts payable on the balance sheet are reflected under the operating activity section of the cash flow statement. It's also worth noting that there are two main methods for preparing the cash flow statement: the direct method and the indirect method. The indirect method starts with the net income from the income statement and adjusts it for non-cash items and changes in working capital to arrive at the net cash flow from operating activities. This method relies heavily on information from both the income statement and the balance sheet. Understanding these interconnections is crucial for analyzing a company's financial health comprehensively. By examining how the different statements interact with each other, we can gain a deeper understanding of a company's performance, its financial position, and its ability to generate and manage cash flow. We've explored the four main financial statements, but our journey isn't complete yet. There's one more crucial element that often gets overlooked: the notes to financial statements. Think of them as the fine print that accompanies the main reports, providing essential contexts and details that enhance our understanding. The notes serve several important purposes, such as clarification. For example, they explain the accounting policies and methods used to prepare the financial statements, ensuring consistency and comparability. They also show additional information that provide details about specific line items in the statements, such as the composition of inventory, the terms of long-term debt, or the nature of contingent liabilities. They also show disclosures that reveal significant events or transactions that occurred during the period but might not be readily apparent in the statements themselves, such as lawsuits, acquisitions, or changes in accounting estimates. In essence, the notes offer a wealth of information that helps us interpret the financial statements more accurately and make informed decisions. They bridge the gap between the summarized figures presented in the statements and the underlying reality of the company's financial activities. While the notes may seem dense and technical at first glance, they're crucial for gaining a complete picture of a company's financial health. Investors, creditors, and analysts rely heavily on the notes to assess the company's risks, opportunities, and overall financial performance. Well, we covered some basics in this video, from focusing on the mysteries of financial statements to understanding their interconnections and the crucial role of the notes. If you're eager to dive deeper and gain a comprehensive understanding of financial accounting, I invite you to check out my free video course. It's packed with in-depth explanations, practical examples, and valuable insights that will empower you to navigate the complexities of accounting with confidence. You can access the course through my website, jofessor.com, or directly here on YouTube. Whether you're a student, entrepreneur, or simply curious about accounting, this course is designed to equip you with the knowledge and skills you need. Thank you for watching. Cheers.